If you were to give advice to anybody that may be looking, that they invest in like small duplexes, triplexes, and they want to buy their first, like maybe 15 unit property, what advice would you have if you were talking to yourself about those type of deals? Would it be just go bigger, or would you say, no, these are a good learning curve and there's opportunities there?
Yeah, I think find a good partner. Like don't try to do everything yourself, because the more you try to do things yourself, the slower you'll go. Like if you want to go faster, you got to find partners to split up the work and to specialize in certain things that you're good at, because not everybody's good at everything. I think by creating a team with trusted partners, you can take down more and also minimize your personal risk into any one deal. And that's always been my strategy is diversification is pretty much the only free lunch in investing. So I follow that. And within the real estate sector, I try to diversify by being in many deals, many geographies, and also spreading out the workload so that, I don't have to do everything.
Hello and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau. And today we have a great guest. We're going to talk all about multifamily syndication. We'll even maybe talk about Hawaiian real estate. Please welcome Duc Ong. Duc is located in Hawaii, although he invests all over. He's got holdings in multiple states. He is a real estate salesperson in Hawaii and is an active selling beautiful properties all throughout. Focus on Oahu. Were you born in Hawaii?
I know I was born in Vietnam originally, and then I lived in California for a while, Southern California.
Okay. I was a Northern California transplant, now in Nevada, but Hawaii is a great place to be too. And we were talking in the residential real estate market there is crazy like it is in the California, Nevada, and Arizona, and most parts of the world. It's shortage of inventory. And so that's the biggest challenge in the sales business, right? Is like getting inventory. Because are you guys at like a shortage too?
Oh yeah, I mean, it's easy if you're a seller, and it's super hard if you're a buyer because there's too many buyers and not enough listings, just like anywhere.
So you have a physics degree, and I kind of knew that. Like when I asked you that, I'm like, I bet you do the underwriting of all your deals. That's kind of your position in the group. So when you guys started your real estate investing group, which is called Tri-City Equity, and you can visit them at tricityequity.com. How did you guys meet and formulate your team to start investing in multifamily properties?
Actually, through real estate meetups and networking. One of the partners, Vince Gettings, actually helped him buy a single family in Kapolei when he lived in Hawaii. He's since moved back to Midland, Michigan, where his wife's family's from. So but through networking and just talking and trying to hit the same goals together.
So you had a background in residential, and then you started getting into multifamily, and you first started, like many people do, with smaller multifamily. And how were you like researching and finding deals? What was your thought process originally when you started out, like looking for multifamily?
My first market was Indianapolis. We actually went with a group from Hawaii to Indianapolis to buy smaller multifamily and single families. I ended up partnering with somebody on that group to buy a 3-unit. And then within a year or so, we sold it and made a decent profit. I didn't really like being in that market. So I just got out and then went into Pittsburgh and started partnering with a local guy there. And since then, we now own 15 units in Pittsburgh, a 10-unit, a 4-unit, and a single family. And then, just started snowballing to bigger and bigger deals.
Very cool. Pennsylvania, I just bought a duplex there, and it's interesting because I bought it in a small town, and they have their borough there has their code enforcement. You have to do an inspection prior to renting out properties. It's like, I'm not used to having to do that kind of stuff because I own a bunch in South Bend and we don't have to do any kind of, so it's kind of a learning curve because they're pretty strict. They give you a detailed punch list. I was surprised. I just bought this duplex. I'm like, oh, I have to do all this stuff. Is Pittsburgh the same way? Do they have like the code that you have to get the rental permits? Do they actually do inspections now?
Yeah.
Okay.
It's the same thing. Yeah.
Yeah, so that's all throughout Pennsylvania, I guess. Not every state is the same, obviously. So there's always a little bit of a learning curve because that was the first property I bought in Pennsylvania, and I was like, okay, I didn't know how strict they were going to be, and they're pretty strict. I mean, they're definitely you got to be careful what you buy and knowing that you're going to have to do a bunch of punch list stuff. So that was a good learning curve for me. So, so after you got into Pittsburgh, do you still like the market, or you look for deals there? Or are you kind of like, not really love that market anymore and have grown out? Or are you actively looking in that market as well?
I guess it's really up to my partner to determine if like there's a deal good enough for us to buy. Like we're always looking to buy, but like we haven't seen anything that meet our criteria there. And yeah, but my focus primarily is the larger stuff now. So since then, Tri-City Equity, we bought a 52 unit in Saginaw, Michigan. And then after that, we started doing syndications. So our first syndication was a 48 unit in El Paso, Texas. And that one we recently exited about a month ago for a 32% IRR. So investors are happy with that. And then since then, we started doing more and more syndications. We got another 58 unit in El Paso, another 48 unit in El Paso. Then in Michigan, we picked up another 22 unit in the JV, and then 64 unit in Johnson City, a 72 in Salem, Virginia, and 102 in Roanoke, and then a 58 unit in Berlin, Maryland as well. So just increasing our kind of deal size and quality.
That's great. And you kind of focus on the underwriting of the deal. So you're not really on the business development side of talking to the brokers. You really get involved when there's the deal, and then you pro forma and do your thing. How did you learn your modeling? Did you take any mentoring, or where'd you kind of learn? Because I know you're a very smart guy, obviously with a physics degree. I'm just curious on, who you got the most value out of when you were studying kind of the way they underwrite.
Our primary model is based off of Rob Beersley's model. He wrote a fantastic book, How to Underwrite Multifamily. And it's kind of the most simple and elegant approach towards value add. So it's specific to value add, which is all we do as Tri-City currently is value add multifamily. So yeah, I mean, it has all we need. And then from that model, of course, like we built our own add-ons and like tweaks to it and adjusted certain assumptions and according to our template for how we operate. But yeah, primarily that's the basis for our underwriting model.
Cool. Do you work on do you do any capital raising or a combination, or so you also do capital raising?
Yeah, we all raise. Everybody on the GP raises.
And so like, when you guys, just from like if anybody's listening out there, do you guys just kind of partner, like who brings a certain percentage of money and gets certain allocations? Is that usually a fair way to split between partners, or is it just always a set structure?
And we have different buckets for like certain contributions to the GP, and then according to your contribution to those buckets, you get allocated your points for the GP.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau Eckstein here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day. So what are your goals going forward? I mean, the market seems way tighter than it was. What markets are you kind of focused in right now that you think there might be some opportunity?
So we actually like Texas a lot. And yeah, like right before this call, I just heard that we won one of the deals in South Dallas that we were bidding on. So yeah, that's going to be exciting. It's going to be a lot higher quality market than the other ones that we've been working in. I mean DFW, so super low cap rate market. And yeah, like we're looking at higher quality stuff like B plus, A minus stuff outside of Detroit. So because my partner Vince is in Midland, so he's nearby. And our property manager, MDL, who we've been partnering with on some deals over there in Michigan, would be local to that deal. That's another deal that we're looking at, but kind of just all over, but primarily Texas, Carolinas, Tennessee, kind of that mid-Atlantic, Southeast area. Yeah, that's kind of where we're looking at mostly.
Cool. So on some of your, like you actually on some of the deals partner with the property management company, because they're boots on the ground and they're in the deal. So it's more advantageous for you guys because they're more committed. Is that kind of the mindset with partnering with a large like MBL? They manage a lot of doors, I assume, in the market. And so I see that happening more and more. I'm just wondering kind of thought process about partnering with a property management company.
Yeah, and there's been a lot of times when being a partner with them has helped tremendously in terms of flexibility of like financing, for example. Like sometimes they can help us out by floating an invoice until we get a drawback from the bank. And yeah, I mean, it's worked out well. I mean, I wouldn't recommend just a blanket statement to do that in general. Like you got to be really careful about who you partner with. But we like the property manager partners that we have in the two setups, both in El Paso and in Michigan.
Okay, that's interesting. That's good though. I mean, I get it. Like I think like the hardest part is getting good property management. So why not have somebody that's vested in the deal involved in the project, right? Because like if it doesn't perform, they're not going to make as much money in the long run. So it's a really good idea that I didn't really think about, but I could see why it would be of value. So you just got awarded in the Texas Triangle, right? I just learned about the Texas Triangle and I didn't realize. It's just amazing. I interviewed another gentleman. I didn't even realize like all the stats, like how many Fortune 500 companies are there, like the job growth. It's just phenomenal. So I understand why you guys want to buy there. And this asset, is it like 100 unit type of property or that you're
52 units?
52 units.
It's on the smaller side, but I mean, it's in a better market, a much faster growing market than like any of the other markets that we're currently in.
So when you were initially underwriting it, like there was definitely a value add component. It's a B plus type property where you can maybe make it an A minus by doing some improvements. Is this kind of a light cosmetic? Or are you going to do the interior upgrades? What is it?
Oh yeah, we're going to do the full upgrade package, and yeah, it'll be expensive, but it'll most likely be worth it for the demographic in that area. So
is that like something that it's currently rented for like 1,300 a unit and you can move it to like 1,500, 1,600? What kind of movement?
It's currently like rented for like 1,100 and we're trying to push it to 1,400.
Obviously the occupancy now is probably pretty good, right? You gotta the process then would be slowly send letters, you're raising rents, and then natural progression would be there'd be some turnover, then you start with those units. Is that kind of the process of slowly turning the property?
Yeah, and at the same time doing exterior updates like right away to kind of signify to the market and to the resident base that there's a new sheriff in town and everything's going to be improved and better. Yeah,
that's pretty interesting. And that's the beauty of multifamily, is that you can force appreciation by doing that. So and like going in, what would you expect like the average turnover for the unit to cost? Like if you're putting new flooring, carpet, you already have your quotes on that and everything right now, or just soft quotes?
It's going to be in the ballpark of like 10 grand. Just based on like inflating costs for supplies and everything. Like, so yeah, maybe 9 to 10 grand. To do like granite and all that. So,
and is this a deal that your group's taking down, or are you partnering with another general partner on something like this?
Just our group. I mean, it's a small enough deal that I think we don't need another group. But on that on another deal that we're bidding on, it's much bigger. So that one will most likely need to bring on at least one or maybe two other groups to help raise and take down a deal.
Great. And so in your Tri-City Equity group, how many partners are in that group?
There's 5 partners total. So I'm the CFO, so I handle like the finance, underwriting, investor relations. Vince is our COO, so he handles the operations side. Duran is acquisitions director, so he handles a lot of the deal flow, acquisition stuff. So before it hits my desk for underwriting, they go through a quick screening process and they review a lot of deals before sending me deals to underwrite. Yeah, and then we also have Steve, who he's a home inspector as his day job, so he helps a lot with like DD and flying out to the property and inspecting it from a home inspector's perspective. So he catches a lot of things. And then Matt also helps with some projects, and he's based in Fayetteville, North Carolina, so it's kind of local to that area. So yeah, so we kind of have a distributed team kind of all over.
Yeah, that's pretty good that you guys have such a big team. That, I mean, most that I see are like onesie twosie type of syndicators where you guys have 5 and you each have different strengths. And so you've probably gotten so good at underwriting deals because you've probably underwritten a ton of deals, you know, to buy one deal, I'm guessing.
Yep.
When you initially get a deal, is it usually in like the first 10 minutes, you probably know if it's a deal, or like you're like, this isn't a deal, and you just put it aside? I mean, you can now evaluate deals very quickly.
Yeah. I mean, it's just a matter of plugging in the inputs and then seeing if that meets the ballpark of what we're looking for the output, which is an equity multiple of around a 2, ideally, or like at least close to that, like maybe 1.8 or something.
Can you explain equity multiple to people that are listening and might not know what equity multiple means?
Yeah, so equity multiple for us, it's always a matter of time frame, right? But we assume a 5-year exit plan. So within 5 years, if it's a 2x equity multiple, then it's a 200% return. So we're looking to multiply your initial capital by 2. So if you invested, say, 100,000, if we hit a 2x equity multiple in 5 years, then the total return to you should be 200,000, which means you would have made a profit of 100,000.
And that's cash flow and then equity at time of sale.
Yep. Yeah. The total of cash flow and profit from sale.
Got it. And the one you just exited out of, it was close to 2 that you sold.
Oh, yeah. So that El Paso deal, it was a 1.74 equity multiple in 1.8 years. So a lot faster than the 5-year projection, and a lot higher than the initial pro forma.
So that means when something like that happens, then their IRR is a lot higher because it's a shorter time frame, right? Okay.
Yeah. So it was a 41% average annual return. If you take that 74% return and divide by the 1.8 years that they held the capital for.
Yeah. So when you're looking at a multifamily deal, obviously you're looking at DSCR, like, hey, is this thing cash flowing? What's the DSCR for lending purposes too? Then you're looking on like a cash. What are the benchmarks you would say, like, for, let's just talk about a passive investor that wants to invest it as an LP and they're looking at different syndicators. What benchmarks, as they're looking through like, the offering memorandum and the presentation, the PPM and so forth from a syndicator, like what numbers should they really look at, from like a return standpoint, do you think would be most advisable?
Well, I mean, I guess those 3 metrics that I mentioned, the internal rate of return, the IRR, which measures your return if you take time value of money into account, the average annual return, which is just your straight simple return annually, and the equity multiple, which tells you, how many times are you going to multiply your equity and, within what time frame. I think those are the 3 kind of most important metrics at a high level. And then, of course, you can dig deeper.
Yeah, the IRR seems to be the most important, right? Because like that would see like the biggest benchmark. Like, what is your actual IRR? Is that kind of what you would think too? Is that like this is what really, because it's really the time, it measures everything. Because the multiple is, I invested 100, I got 200,000 back in 5 years from now. But the IRR identifies the time and the value of your money, like how fast the velocity of money moves, and that's also a good return. But a lot of passive investors that are, the reason people invest in syndications is because they can get higher returns with the right sponsors, right? I mean, at the end of the day, what are your options? You can be an operator yourself and deal with all the headaches. and having to find and underwrite deals and manage deals. Or if you have money, you're, probably best suited to be a passive investor as a limited partner, because you're really getting, they get the majority of the returns. I mean, they do put up the money, but they get the majority of the returns, and they have very little headache. So as an LP, your main job is to understand the deal from a high level. Like, what am I investing in? And then who am I investing in, right? Like, who are the syndicators and what's their track record? And so it probably gets a little bit easier now that you guys have a pretty darn good established track record to raise capital versus like on your first bigger deal. I'm assuming that might have been a little bit like, oh, now money comes to you a little bit easier.
Oh yeah, definitely. I mean,
Yeah.
that's just with anything, right? Like,
Yeah. So if you were to give advice to anybody that may be looking, that they invest in like small duplexes, triplexes, and they want to buy their first, like maybe 15 unit property, what advice would you have if you were talking to yourself about those type of deals? Would it be just go bigger, or would you say, no, these are a good learning curve and there's opportunities there?
yeah, I think find a good partner. Like, don't try to do everything yourself, because the more you try to do things yourself, the slower you'll go. Like, if you want to go faster, you got to find partners to split up the work and to specialize in certain things that you're good at, because not everybody's good at everything. I think by creating a team with trusted partners, you can take down more and also minimize your personal risk into any one deal. And that's always been my strategy, is diversification is pretty much the only free lunch in investing. So I follow that. And within the real estate sector, I try to diversify by being in many deals, many geographies, and also spreading out the workload, so that, I don't have to do everything.
That's really good. That's like, there's no I in team, right? Like, and you're a very smart guy. So I know, like, you know that like everything is about leveraging, right? Like, where your skill sets are. And that's probably something I should be looking at. I've had some partners in the past on deals, and sometimes they work, sometimes they don't work, but you got to find the right team members, and that's how you can grow a lot faster, and you can diversify risk. That was a nugget. I'm gonna highlight that in the video for sure, because I really appreciate that. What do you do other than real estate investing? What do you do for fun, personal development, that kind of thing?
Well, I have a 20-month-old, so he keeps me super busy.
Congratulations.
Thank you. But I also surf. Try to surf as much as I can. That's why I moved to Hawaii, because Hawaii has the best surfing in the world. And yeah, I try to surf almost every day.
Do you surf with Brandon Turner at all? He's on a different island, is he?
Yeah, he's on Maui.
Okay.
I'm on Oahu.
Very cool. Duke, this was a pleasure to have you on the show. Where can people learn more about yourself? Where would you want them to follow you? Or, I know you have a podcast called Cash Flow Project. Where would you send people that want to learn more about you and your company?
So you can always check out the Cash Flow Project. We're on all the major podcast sites. And if you want to check us out, tricityequity.com. I wrote a little free ebook you can download about passive investing in multifamily. We're also holding a conference in Kolina on Oahu, July 21st to 24th, called Hawaii Millionaires Mindset Conference, The Blueprint. We'll have tons of speakers and networking opportunities, not to mention the tax write-off. It's a business trip to Hawaii. So you can check that out at millionaires with an S, mindsetblueprint.com.
Awesome. Thank you so much. And thanks everybody for watching. I hope you really took note of that nugget about building the right team, because I think that was a big takeaway. As interviewing people on my show, I always get these nuggets from each interview. So it's like, I love interviewing, because I'm like, okay, you always learn something. And that was like the big takeaway from this episode, that you got to build the team and just to reduce risk and stress. And so really appreciate you for joining us, and aloha.